Welcome everyone to our third lesson in our Market Profile Trading Strategies course. As usual, we have some interesting things to discuss and to talk about. Please usually pause the video lesson to take a couple of moments to read the disclaimer. Today on our agenda for our third lesson, we are going to get into a little bit of background information to help us better understand the market in general, but more specifically, the market participants. The profile is really a function of market behavior. So it is very important for us to get a good grasp on the players in the market and the types of behavior that they engage in, and then ultimately how this behavior manifests itself in the actual profile chart. So we will begin today with a brief look at the financial markets in general, and then we are going to get into a little bit of a detailed discussion on market participants, who they are, and what their perceptions of the market are, generally speaking, and how these perceptions influence behavior. And then we are going to begin to see how some of this behavior manifests itself in the actual market activity and how this helps us in our analysis of the profile charts that we see develop before our eyes. So let's begin now by taking a look at the financial markets. I always like to begin any discussion really at the very beginning. What is a financial market, and where are they, and what do they do? Well, the financial markets is a very, very broad term. At one point in time, people used to strictly associate financial markets with Wall Street or perhaps London. It is very important now to understand that the financial markets are a global phenomenon. They are really an international system. They involve almost every country in the world. Certainly, there are certain economies that are more prominent in the financial system than others, but nevertheless, it is really a global system. No one in the world is not influenced or touched by the financial markets. They impact the entire globe. Now, what does this system do? It really allows the exchange and flow of capital throughout the world. Now, capital is not limited to any one specific territory or area of the planet. Capital is now flowing at an incredibly rapid rate around the entire globe. And this was recently evidenced by the magnitude of the trading that we've been seeing in the Forex market. Last year, we had a record day where trading in the Forex markets actually was a little over or about $4 trillion within a single 24-hour period. That is a phenomenal number. But it goes to show you the extent of the capital flow around the globe. The other important element of this is we need to have an appreciation for the 24-hour nature of the market. The market really rarely sleeps. And so regardless of where you are on the planet, you need to be cognizant of the fact that there's going to be activity, even though in your region of the world, people may be asleep, but there's another part of the world where the market is vibrant and active, and you have to take that into account when you look at the overall development of a profile chart or any chart for that matter. Now, just a brief review of the importance of these financial markets. No healthy economy anywhere in the world can exist without a healthy financial market. because these financial markets really facilitate the raising of capital, the transfer of risk, and international trade. And so a healthy economy now is really synonymous with a healthy financial market. There are certain centers around the planet now that have become more dominant as financial markets, but nevertheless, I want you to keep in perspective that the financial markets involve the entire planet. It is not about any single market. I also like to quickly review with you the various types of financial markets and emphasize to you that these markets are all interrelated. Even though these instruments are very different, and sometimes they may even have inverse relationships to one another, meaning that if one goes up, the other might go down, nevertheless, all of the financial markets are intertwined and interconnected, and one certainly influences the other. There are, of course, stock markets, and there are stock exchanges all throughout the world and the planet. The more dominant ones, if you will, are certainly the London Exchange, the Wall Street, and we also have the Nikkei in Tokyo. Those are some of the bigger ones, but there are stock exchanges now in almost every major economic center anywhere on the planet. Bond markets. You need to be aware of the bond instruments. They're certainly a very different instrument from stocks. Bonds are more about lending rather than equity. And we have commodity markets, and these are also very important markets in today's international economy. The commodities have a direct correlation to the currency markets, and naturally, they also influence the equity or the stock market. Then we have money markets, and we have derivative markets. I want to just take a couple of moments to highlight for you the incredible growth that we've seen in the past decade in the derivative markets. And what do we mean by derivative markets? Derivative markets are really derivatives of stocks, bonds, commodities. They're markets based on other markets. To make it a little simpler, a derivative is certainly a futures contract or an option instrument on an equity or a commodity. Those are all derivative markets. So they're really based on another market. They're a derivative of another type of instrument. And these have become incredibly popular in terms of trading, and many professional traders are extensively involved with these instruments. We also have insurance markets, and last but not least, once again, the foreign exchange markets, or more popularly known as the Forex market. All right, now that we've talked about the financial market in general and the various instruments in this market, it is really time for us to talk a little bit about the market participants. Who are really the key players in these financial markets, and how do they influence the market? And this is really a very important question, because as we continue our study and our analysis of profile charts, we will be looking to see if we can identify really which player is influencing the market at a given point or a specific point in time. So it's really very important to get an appreciation for these participants, what their goals are, and what type of footprint they leave in the market when they in fact engage in transactions in the market. There are two key participants. Certainly there are many different types, but I am going to basically focus our discussion on two key types of participants in the marketplace. First of all, from a formal standpoint, we call these sell-side and buy-side participants. Let's talk a little bit about the sell-side participants. These are the participants in the market that originate or create financial products. So the sell side is really made up of investment banks, financial instrument distributors for the financial products on the market, resellers, and brokers. And strictly speaking, or typically speaking, these participants usually make their money in the market based on commissions and fees that they charge. In theory, this is where they are supposed to be making the bulk of their money. So we're talking really about banks, we're talking about brokers, we're talking about dealers, we're talking about market makers. So many of these players, really, the main source of revenue for them are the fees that they collect as a result of the transactions that occur in the marketplace. And by the way, this is a significant chunk of money. So it's nothing to be sneezed at or taken lightly. However, I don't want you to think that these participants are not also involved or playing a significant role on the buy side. And as a matter of fact, as I will point out a little bit later, the images are starting to get blurred where in fact sell side and buy side players start to look a lot alike and they become intertwined as well. And this also makes it a little bit difficult sometimes to be able to discern where the activity is coming from in the market. Now, having described the sell side, let's talk a little bit about the buy side. The buy side are really the participants with capital, the people that come to the market to buy the financial products that the sell side has developed and is offering to the marketplace. So who typically are these buy-side participants? They are very large pension funds, they're mutual funds, they're insurance companies, and they're hedge funds. Basically, they are participants with a very large pool of money, the heavy hitters, if you will. These are the players that when they come into the market, they influence the market. They can change direction of the market, and they can have a very significant influence on the market. The sell side, on the other hand, are really the go-betweens, the participants who are in the market short term, who are trying to sort of make a little bit of money on the transaction side of the market rather than the investment side of the market. This is very important to understand because as we continue our discussion and we talk about time frames, this will play a very significant role in our discussion and also in the perspective of value. I have a couple of articles that I want to share with you today, and in each article I want to highlight for you some key points. In this first article we have three key points that we are going to look at together. The first point is I want you to get an appreciation for the magnitude, the level of profits that are made in trading. Okay, $3 billion Goldman made on trading gains. Now, is Goldman a sell-side player or are they a buy-side player? And this is really a tough question because as I was telling you a little bit earlier, many of these players in the market or these key participants usually play on both sides of the fence. So yes, Goldman Sachs is an investment banker, and so they are often very active on the sell side. They do generate and produce various types of products. They do collect money in the form of fees and transaction fees on items where they are a reseller, a distributor, or a broker. But by the same token, they're also a very active player in the market, and they could in fact come in as an investor. They have large funds, and they could be on the buy side as well. So Goldman is one of those players And as a matter of fact, they get a lot of criticism for this because often there are conflicts of interest. But nevertheless, I really want to highlight for you in this article as a first point the magnitude of the profit that is made on these trading gains, on the trading side of things. Second, the key point that I want to emphasize here in this article is the compensation and the magnitude of compensation that is paid to participants in this business. And I'm not highlighting this to sort of show you extravagance, but I really want to highlight a more significant and a more important point. A lot of market participants or traders have the perception or the concept that humans no longer really influence the market. It's all machines, it's all computers, it's all about algorithms. Well, if this were the case, why would Goldman be paying $5.35 billion in compensation to its employees, to people that work for them? And the reason is these individuals really still play a significant role in the decision-making process. So you have to understand that markets are still about human behavior, human decisions, and human perceptions and human judgment. And if these judgments make money, then obviously you have to compensate the individuals that made these decisions. And that's why Goldman is paying these kinds of salaries, bonuses, or however they choose to compensate their executives. And as a matter of fact, they were getting a lot of criticism because they didn't want them to pay this, but they still went on and paid it because it's performance-based. These people earned this money based on their trading activity in the marketplace. So keep this in mind, because I really want to drill the point or emphasize the point that market behavior is influenced by individual decisions. Naturally, they're influenced by individual decisions made by major players, not individual decisions made by a small trader or just a regular, ordinary individual. We want to make clear that point. The last item or point on this article that I want to share with you is the fact that these types of profits are not generated in any single equity or market. Take a look. The company said bond, commodities, and currency trading buoyed its profits for the second quarter. So look at the source of where this money is. It really isn't in any one specific market. Now I have another article, and in this article I've got two quick points that I want to highlight for you. The first point that we want to look at is the fact that Goldman profited on its trades while clients lost on its advice. So take a look now. They're playing on both sides of the fence. They're trading, and yet they're giving advice and getting money for this advice for the buy side, or they're giving the advice to the buy side. The buy side player in the market lost money, whereas the sell side made money on trading. So keep that in mind, that some of these players, when they play on both sides of the fence, sometimes have an unfair advantage. Now, also, once again, I want you to take a look at where the advice was and what types of things were traded in the market. So clients who used tips lost 14% buying the Polish zloty versus the Japanese yen, Chinese stocks, and British pound, New Zealand dollar. Okay, so again, they are trading in the currency markets. So these large players are now becoming incredibly active in a wide set or a variety of different markets. Their activity is not contained or confined to any single market. All right, my last article that I want to share with you, and once again, it's to emphasize the point of the magnitude of profits that these participants make. Take a look. It's not only Goldman. Trading profits up 11% for banks in general. Again, the sell side participants in the market. Their profits are skyrocketing because of trading activity. And JP Morgan, which is another major bank, leads the way. And if you go on to read the article, you will find that the levels and the magnitude of profit is also incredible for these market participants. The banking behemoth has earned more than 8.1 billion trading thus far this year. These are incredible numbers, folks. So hopefully this gives you an appreciation for the magnitude of the market, the magnitude of profit in the market, and the importance of being able to understand the flow of capital, where capital is coming from, and these key participants in the market. All right. I hope now I have at least gotten you to appreciate the significance of market participants. And now, as students of the market profile, our job is to take a look at the profile and see how we can analyze this behavior and learn to trade in harmony with this behavior rather than against it. First of all, let's review one of the key concepts that we have discussed in a previous lesson, and that is market activity is really a function of three key elements: time, price, and volume. Always keep this in mind. This is really our bedrock foundation of understanding, analyzing, and using the profile. So always now start your thinking in terms of time, price, and volume when you look at any profile chart. So now we are going to begin to look at participant behavior in relationship to each of these key components in market activity. And we're going to begin with time. The first question that I would like you to be thinking about is, do all market participants view the market in the same way? And really, it should not take much thought to answer this question, because it is a very easy question. Absolutely not. Market participants do not view the market in the same way. Each participant comes to the market with a very different perspective. Now, there is no way on earth that we can understand the perspective of every single participant, so we have to begin by classifying or categorizing the perspectives in the market into key elements or into key perspectives. And I told you that we would begin looking and analyzing the market in terms of time. So once again, to review, we're always going to be looking at time, price, and volume. Time, price, and volume. Let's begin with time. When market participants come to the market, they're going to have one of two key perspectives: either a short-term perspective or a long-term perspective in the market. And you need to understand that this in itself will dramatically influence the behavior of that participant. The short-term perspective is really about making money in a very short-term period of time. And so naturally, their behavior in the market is going to be different from someone who's coming to the market with a long-term perspective in the market. Stadelmeier, who developed the profile, identified these same exact two time frames or perspectives with a different type of vocabulary. And since we are studying the profile chart, let's take a look at the vocabulary that Stadelmeier used. For the short-term perspective, he identified what he calls the daytime frame trader. And basically, by the daytime frame trader, he is looking at sell-side participants that I have identified for you earlier in this lesson. In other words, he is looking at traders who are going to be actively participating in the market, but their goal is to really be flat at the end of the day. What do we mean by that? Well, we mean that regardless of the amount of transactions that they have during the course of the day, at the end of the day, they will hold no positions to the following day. That's a daytime frame trader. They're always flat. Their positions are zero at the end of the day. So what are the general characteristics of behavior of such a trader? On the sell side, these participants typically only participate in areas where they feel there's a lot of liquidity, because they're often going to come in with a very large sum of money, and they're only going to be looking for just a few pennies or a very small fraction of profit, and they will quickly get out. The role that they play in the market is very important because they generate and create liquidity in the market. They're not really investors. They're really facilitating transactions, and in doing so, they make a significant amount of money. So they're continually buying and selling over the course of the day. So naturally, these daytime frame traders have very different strategies and a very different perception of value during any point of time. And this really sort of is at the heart of understanding profile charts and analyzing profile charts. The daytime frame trader looks at value and perceives value in a very different way from what we're now going to call the other time frame. And the reason we call them the other time frame and not the long-term time frame is basically because when you begin to think of long-term, there are many different types of long-terms. You could have someone who's going to hold a position for 2 or 3 days, would you consider that long-term? Or someone who's going to hold a position for a week. Someone may hold a position for several weeks. Someone may decide to, in fact, hold a position for a month, a few months, or perhaps even a year or more. So when we get to the other time frame trader, the rules of the game really are very different, and they change significantly in terms of perceptions of value from a daytime frame trader. The daytime frame trader has a very confined concept or idea of value because it's based on the day's session. The other time frame trader is looking at things from a different time perspective, and certainly not all other time frame traders are going to even have the same perspective of value. So really the one player or the one type of player in the market that is going to share or have a common value or a common perception of value in the market is the daytime frame trader. The other time frame trader is going to have a significantly different perception of value. So to review and emphasize the point with you now, the time frame perspective influences the perception of value in the market. And as you are probably aware, many philosophers will tell you that perception is often more powerful than reality. So this is a very important concept in understanding the market, the idea of where is the perception of value and how do different participants perceive value, and how does this perception influence the behavior in the market. And this is really what our analysis and our studies are going to be about. The market profile as a chart or as an analytical tool is really a display or a representation of the interaction between short and long-term market participants. And basically what is happening in the profile is that volume, now the second element in our basic three key elements that we're always focusing on. We've been talking about time, price, and volume. So the second element, volume, is being distributed between the short-term and the long-term players. And this distribution gives us the bell-shaped curve that we tend to see when we look at a market profile. Now that we've reviewed some of these key concepts and we've identified the key market participants, I want to actually take you to analyzing and sort of interpreting this activity as it happens and occurs in the market. A key concept that every profile student needs to understand is the basic pattern of market behavior in any market is really a continuing point, counterpoint, balance to imbalance, and imbalance to balance. In other words, you will rarely see a market that continues to move in any one direction for a long period of time. The market is always vacillating. It's going back and forth, balance to imbalance, imbalance to balance, point, counterpoint. And that is the nature of the auction market. So that you will observe, for those of you who have had an opportunity to study and look at other types of charts, even as the market is going up, there is always a retracement, as we call it. It goes up, comes back down a little bit, and then starts moving up again. There's always that point, counterpoint, balance, and imbalance. The beauty of the profile is this really shows us, it really shows us this movement in great detail. So let's take a look at this profile chart together and take a look at this day, this first day, which is January 5th, that we're going to look at. And we're looking at a profile of the ES Mini here again. And I want you to take a look on January 5th. What does the profile really look like? What's happening here? I have an area where prices tended to stay for some time, and this happened during the initial balance of the day. And then we tended to have sort of an equal distribution in the afternoon or in the evening. Prices started to go up, and then prices also started to go down. But we never really developed a nice bell curve. And you notice we had a gap in this area here. But notice what started to happen on the following day. Look at where prices were on that day. Okay? They came in to balance this imbalance that was in the market. We had a lot of heavy activity up here, but there was very little activity. There was an imbalance in the market. The market still did not have a definite direction that it wanted to do or to go in, to move into, and so it had to balance itself. And the balance does not necessarily come in a single session. It may take several sessions, but the ultimate goal of the market is always to develop a balance. Now, what I've done here on this chart is I've created a composite, a blend, if you will, of the 2 days together. The 2 days that we saw, these 2 days that we looked at together, now take a look at them when we compile them together. This is what it looks like. Now notice the bell curve that develops, and notice how the idea of balance comes into play. The market is always moving from this imbalance to balance, but ultimately it really wants to reach a state of balance. The interesting thing is, once this balance is developed, this is when you are likely to see some sort of a directional movement ensue once the balance is developed. So let's review again. The markets ultimate common objective is to develop a balanced distribution. Market profile data basically captures and continuously updates the market development process to show us this activity between balance and imbalance. So I want everyone in the class, perhaps by the next week or so, if I show you any type of a profile pattern, I want you to be able to tell me right away whether the market is balanced in that distribution or not. That is a very basic, fundamental skill, but it's very helpful. So learn to identify markets that are in balance and markets that are out of balance. Now that we've talked about balance and imbalance, the first type of imbalance is really a directional move. And we are going to walk together through a directional move from the beginning and analyze it in terms of what happens. So we can begin to develop the skills of identifying these moves when they begin to happen. It is one thing to be able to look at the chart and to tell you what happened, but the art and science that we're really after is to be able to identify things as they are in development. And then that gives us the opportunity to be able to participate and profit from them. So pay attention to these concepts. They're really very important, and they give us the foundation that we need to be able to trade using the profile chart. Okay, let's begin by looking at the start of a directional move. What happens when the market begins to move directionally? The market is really advertising for an opposite response. Now remember, I covered this principle when we talked about auction markets. In an auction market, the prices move in a specific direction, really looking for the opposite response. So if I am moving up, I am going to keep moving up with my prices until I get to a point where I cannot find any more buyers and I meet some sellers. If, on the other hand, I am moving lower in the auction, I will keep moving lower with the price. What is going to shut me off and what's going to stop me? My prices keep getting lower and lower until I meet buyers. So even though I am decreasing, I'm really looking for the buyers. Once I hit the buyers, then that shuts off the directional move and prices start to move back up again. So always keep this in mind. A key fundamental concept in an auction market: the auction market advertises for the opposite response of what it's looking for. And when it meets it, then that response shuts off the directional move and the market starts to shift in the opposite direction. Okay, so when we begin a directional move, let's sort of take it down to the basics. What are the possible or potential outcomes for this directional move? There are only two possible outcomes that could happen when you have a directional move. You are going to either meet buying or you're going to meet selling. It's that simple. So anytime you have a directional move, you are going to meet either selling or buying. Let's begin with a positive or a directional move to the upside and begin to analyze that together. All right, so prices have started to move up directionally. And the first outcome I'm looking at is what happens when I move up directionally, prices are starting to increase, and I encounter selling. So I get to a point, and then all of a sudden, I hit sellers. Now, I'm advertising prices at this point, and who meets me? The sellers. So what is this selling going to do to me? Selling is the opposite response because I was going up, and all of a sudden, I got hit with sellers. So we will find that if we meet sellers, it will stop the move. It will cause the market to reverse and move down, and basically, the up auction ends and the down auction begins. So keep that in mind. If you have a positive directional move, the market is moving up, and all of a sudden it encounters selling, the move will stop. It'll cause the market to reverse and start to move down. Now, it doesn't mean that the market will continue to move down forever. No, it'll just move down to a point where it will again meet some buyers. All right, now we had decided that there were two possible outcomes, and we covered the outcome if in fact we met some sellers with our directional move. Basically, the sellers will conclude or end that move for us and will not be able to move further up anymore because we encountered sellers. Now let's take a look at the second outcome that we had identified, which is basically we meet buying. So we're moving up with our prices, and the up move brings in more buying. What is going to happen now? We don't have any selling. We've got buyers. Well, guess what? Buying is not the opposite response of what we're looking for. So the auction market just has to keep going up. Because remember, the auction market keeps moving until it finds the opposite of what it's looking for. So if it was moving up, it's looking for sellers. And now it found buyers. So it just has to keep going. So the market continues to move higher. And the up auction continues to look for sellers. And the market will keep moving higher and higher until it finds those sellers. And at some point, it's going to find them. No market keeps going up forever. There's always a point when the sellers are going to come in. Now, I want to show you the anatomy of a very strong directional move that we've just had in the past week or two. For Apple computers. It's a beautiful move, and that's why I really picked the profile for it, to show you what a directional move looks like on the profile. Take a look at this. The market opens here, drops a little bit, okay, and then it shoots up. Market did not meet any sellers. So what does the market do when it doesn't meet sellers? Well, it's going to keep going up, and it goes up, and it keeps going up until it got to this point, and then it met some sellers. So what did we start to have happen here? It wanted to go into balance, because this area here is an area of imbalance. Now I've taped in time lapse, and I will show you how to do this when we look at our profile charts so you can study some of these profiles. The development of this profile in action. And I'm going to show it to you in just a couple of moments. So when we have a directional move, we are going to get a negotiation process in the auction market. What this negotiation process does for us is it defines a new price range. And all of a sudden, when the market is taken into this new price range, the daytime frame trader has to look for a value area. So the first thing that you need to recognize is the markets are moved by the buy-side investor or the long-term trader, not the daytime frame trader. So when we see a move like the one we just saw in Apple, this is the product of large institutional buyers, pension funds. I don't know who it was, but they came in and they pushed prices up. All of a sudden, the daytime frame trader sees this movement. So obviously, they're going to want a piece of it. So they start buying. And that causes prices to go up even further, higher and higher. They recognize and they know that at some point, the buying is going to stop. And their challenge is really to identify where this value area is, where this new value area is, where's the unfair high and the unfair low, so they can get out of the market before the market goes against them. And you will see, as soon as this area is identified, you will see the balance or the profile begin to develop a little bulge, as we saw in the earlier chart. So if you notice, and we look again at our chart, we moved up, and then we found that there was an unfair high at this point, and a balance started to develop around here, a small value area. Now, does this mean that prices are no longer going to move up, or prices are going to start moving down from here? Absolutely not. It just means that during this session, this is the area of balance that was created. All right. So prices, when we have a directional move, will move either to an unfair low or to an unfair high. And once they encounter either one of these points, it will force them either down to a value area, or it will force them back up to the value area. Now, the short-term trader or the daytime frame trader loves to trade in this value area. They're not looking for a large amount of profit because they're trading very large positions. They're looking for a small amount of profit, but they're looking for an area that's liquid, an area where they're going to find lots of buyers and sellers. They always focus on value. And in fact, this is how the balance or the bulge is created, because we get a lot of activity during this area here. This is where the market has perceived value to be, so we have a lot of trading, and we begin to see a lot of prints around these prices, and that's how value develops. All right, I would like to actually show you how this directional move evolved over the course of the day, and we will dissect it and look at it as it develops. Okay. Okay, now notice, even though it opens here, it usually in the morning, and we will talk more about this in a future lesson, it goes down to test and see if there's support below the open. It doesn't always sort of shoot up in one direction. So it drops down to test, and then let's see what happens as it continues. Now notice that as it tested, it found support, and always take a look and see, does it come back to the open or does it continue upwards? If price continues to move upward, that is an indication of the strength of the move. If it's starting to fall and come back to the open, that is telling you that the up or directional move here is a weak move. Now also, I want to cheat a little here and show you a telltale sign. Take a look at the volume that came in at this price level. A large amount of volume. Now notice, prices are continuing to move up. Okay, what's happening then? Both the short-term and the long-term buyers have recognized that this is a directional move, so everybody's buying. Take a look at that. Just keeps going. More buying. All right. Now, it stopped at this point, so there was some uncertainty. So we get a little bit of profit taking by the daytime frame trader. So at this point, the daytime frame traders that bought at this point are taking their profits and getting out of the market. Now, who's picking up what they're selling? The long-term trader. And if you can identify and understand this activity, you know that at this point, it would still be a good time to keep buying. And sure enough, take a look at what happens, even though, okay, look at that. It just keeps going up. All right. Okay, once again, the same thing happens. We met some sellers at this point, so prices dropped. All right. Does this mean that's it? We've made the high for the day? You really don't know. But the daytime frame traders realize that we've hit a high or an unfair high at this point, so it may be time to get out, and they start selling. Now, will the other time frame traders start buying from them? And let's see what happens. Yes, they did keep buying from them. But look what happened. We had this unfair high get reaffirmed. So we had some sellers appear again. And so now we're starting to begin to define our value area. Every time we hit this point, it's an unfair high and prices start to drop. So now everyone that understands what's going on in the market begins to realize that this point for this session is an unfair high. Well, where's the unfair low? Well, let's take a look and see. Okay. All right, we went up to test the high again, but we didn't go very far. So it looks like the unfair high is right in this area. See, between 330 to 310. Now, we're still looking for the unfair low. Okay. Now, a POC was identified. So a lot of traders will seek comfort around the POC, but so far we really haven't identified is still to the upside and above the POC. All right, see, activity is still to the upside. Okay, here we go. Now, notice, when prices hit this point, what happened? Did they continue to drop, or did we find support for these prices? All right, look at that. Look at how quickly the price jumped from here to here. So we definitely had support, and if you notice, we've developed a small area of balance on the chart. Testing the lower side again. Okay, came back up. Now notice, the movement is always from balance to imbalance. We're moving from the unfair high to the unfair low. But notice how value completely shifted upwards. Our value lines are the top green line here and the bottom green line here basically show us that value now is at the top of this new price range as a result of this new negotiation that took place, and it is defined in a very small area at the top. Hopefully, this helps you to see how the price movement sort of manifests itself and is developed over the course of the day. All right. All right, so as students of the profile, what we really want to do is to begin to develop the skills that will allow to continue or change when we see a directional move. All right, so focus on this because this is an important skill to have. So when we begin to see a directional move in the market, like the one we just saw, we need to be able to identify if this move is going to continue or if in fact it has met with an unfair high or an unfair low and it's actually going to change and come back right into the value area. And how do we do that? Well, we need to look at how to analyze in the context of a larger time frame. So we are going to have to step out of just looking at this session that we're at and look at the overall picture. Why? Because the picture of both the short-term and the long-term trader will identify for us the big picture. We don't want to focus on the activity of just one single perspective. To have a clear activity of the market, we have to be able to look at both participants simultaneously. Now, we also have to study the development of value and value areas relative to one another, and we also have to be able to examine volume data in the market. And all these are very important elements in our analysis, and we will certainly spend quite a bit of time doing this to be able to interpret what is going on in the market. But before we do it, we have to know what we have to be looking for so that we could begin to look at it. So, you are going to try to determine the direction of the market. Which way is the market really trying to move? That's going to be your first question. And believe it or not, sometimes this can be hard to do. It's, especially if you get a day on the chart that I showed you and the example of Apple, that was really easy. I mean, it was very obvious that that was an up directional move and a very strong and a powerful one. The market doesn't always work that way. But at least you'll have some of these nice days where it'll be like taking candy from a baby. The move will be so obvious and you'll be able to participate with it. But don't count on that always being the case. So we have to be a little bit more astute, or a little bit more clever, if you will, and we have to look and see, is volume higher or lower than the previous day? Remember, again, I want to re-emphasize the three key things that we always focus on: time, price, and volume. Right? Never focus on just one of those three elements. Always take a look at all three together. So we want to look at volume. Is it higher or lower than the previous day? More volume typically means continuation. Lower volume means change. So if we see more volume coming in, it looks like the move is likely to continue. Whereas if we begin to see volume decrease, looks like the move is probably going to fizzle, or we're going to see a change in the direction that we had seen in the market. Also, compare the volume area for the day to a previous day. If in fact the volume area is larger, then there's a greater likelihood that the move will continue in the direction. If the volume area is starting to narrow and become smaller, then the likelihood is that the move will not continue. So what I did was I took a snapshot here of a few days, consecutive days of Apple, and I wanted to show you just an easy example here. We had a directional move, and we have on the 7th here, and this was last Friday, the conclusion of the week. And I want you to take a look at January 7th and sort of think in your mind, what is going to happen on Monday? Is this move going to continue, or is this move going to fizzle and end by Monday and start moving down? If you notice, we had started to develop a value area up here, okay? But some of the key things that I asked you to look at. What happened to the value area between this day and this day? Take a look. Value increased. More importantly, what happened to the volume area? Well, the volume area was even greater. The likelihood is that this move is going to continue is higher than not. And so I also want to point out to you that look at where we ended on, where we closed at a high of the day. And sure enough, Apple opened up significantly higher and did go up on Monday. Now, I want to get you in the habit of learning to analyze markets and collect data. So I'm going to delegate a study for you that I would like you to begin doing on a daily basis. And let's do it for the ES Mini. Each day, I want you to collect the data to fill these numbers. So you're going to identify the opening range price, the opening range close price. You are going to calculate the closing range. You're going to get the POC for the day, the volume POC for the day, the closing range open price, the close range close price, and you're going to calculate, and by the way, to calculate this, it's simply the difference between the close and the open, and I want you to chart or to record the total volume for the day. Begin to develop these sheets on a daily basis for the ES Mini, and in a few days or in a week or two, I will show you how we're going to interpret this data. But part of being a seasoned or a professional trader, you've got to learn to study the market and develop your analysis, and this will be the first exercise that I want you to begin in developing this study with me. And then you can also begin to do this for some of the other instruments that you trade.